Good evening and welcome everyone. Thank you so much for joining Mike and I tonight. The topic of our presentation today is the state of the real estate market today and beyond. Let me share the slides with you. Can you see my slides?
Yes.
Excellent. So this is the usual disclaimer. We're not offering securities. This is done for educational purposes only. Please consult with professionals when making investment decisions. This is strictly to educate everyone. This is TF management team. Mike is our CEO, as you know. We have Yurian, who is our chief of operations, and then Yuri G, who is chief technology officer, and Lilia, who is our office manager and backend support. And I am the head of investor relations. And as you can see, we all have different hobbies and interests, and these are just some of the interests that we have. So why invest with TFMG? We've been in business since 2000, in fund management since 2009. Our goal is to offer our investors diversified portfolio that allow to minimize risks of investing in a single asset. You have a great access point to a fantastic operators by investing with us due to our long-term relationship with operators that have been around for many years. For us, the investors always come first. For the full transparency, we use third-party legal and administration partners, and we'll share the names of them later on, but you probably all experienced working with Verivest, who is our portal and accounting administrator. And we've used several legal counsels that we worked with for many years, and here are their names. So it's Stoltz Rivers and Pinan Nicholson. Those are the two legal counsels that we use. With Verivest, we're gold verified members, which is the highest standard that Verivest offers. And Tampa Opportunity Fund has been audited annually by the Armanina CPA firm.
Thank you, Alina, very much for the introduction and that overview. I appreciate everyone joining. So let me jump straight into the state of the market. So 2021 was by many means a phenomenal year for real estate investors. Just a few important facts. So national rent has grown on average 17.8%, which is really unheard of. In the pre-COVID era, the average annual increase of rent had been 2.3%, and we jumped from kind of boring, slow rent increases to a phenomenal 17.8%. And the housing prices kept up, and average across the entire nation was around 18% price increase. Some markets have done substantially higher than that. If you go and look in places like Florida, 30, 40, 50% increases were not uncommon. And other parts of the country, increases of smaller degree took place. But in general, it was a good year or a great year for real estate across many regions of the country. Now, REITs, Real Estate Investment Trust, this is just again a measure, just to give you a broad perspective. Publicly traded REITs have delivered returns, or the price per unit return in the REITs saw an appreciation of over 40%. And it is a broad measure. Also, a lot of the price increase is investor sentiment. It doesn't necessarily reflect the market conditions, but it can reflect what investors are willing to pay for those units. But REITs have done pretty well in 2021. So where are we now? Well, number one, we are in a very low unemployment environment. And the latest data point was December 2021. Unemployment stood at 3.9%. Just for comparison's sake, in November it was 4.2. And just a little bit later in the presentation, we have a slide on the historic rate of unemployment. But unemployment still is dropping, and we have substantial labor shortages driving wage increases. And this is true across multiple sectors of the job markets, from entry-level jobs all the way to highly educated professionals. The low unemployment drove substantial wage increases. And even in the banking industry recently, CEOs of major companies, including Goldman Sachs, announced that they escalated pay increases for their broad range of their staff, from entry-level bankers all the way to the partners in the business. So the wages are going up. Personal income has gone up in the past 12 months by 6.9%, and that's substantially higher than the historic average of 3.2%. And inflation, I think that's the news in everywhere, on TV, on social media, everywhere. Everybody is well aware that there is high inflation. So generally, CPI is a very, what I call it, it measures the inflation variables that the government wants to measure. Also, the increases to Social Security recipients are tied to CPI. So CPI lags what I call street inflation. Even CPI reported last year inflation of 7%, which is historically very, very high. So what does it mean? It just means we're paying more for goods and services. The best way to understand inflation is if you have 10 apples and $10. What happens when you have 10 apples and $10? It's $1 per apple. When you have supply chain problems and shortages, and instead of 10 apples, there are eight apples, the price per apple goes up. And if number of dollars in circulation through government support, through injection of capital, through various programs, number of dollars in circulation goes up. The consequence is price per apple goes up. That's the classic inflation. So we saw substantial inflation last year, and it's likely going to continue, but let's keep chatting. So here is the US unemployment rate for the last 20 years. And as you can see, we've gone through cycles. You could actually see the 2008-9 problems when unemployment after the crisis was pretty high, almost at 10%. And then slowly over time, it has gone down to the pre-COVID level. And then during COVID, unemployment spiked. And then it's been coming down ever since. And the direction of unemployment fall is pretty substantial. Why is this important? Well, it's important because low unemployment causes all kinds of issues, including inflation. Let's go to the next chart. And this is the graph of the relationship between the unemployment rate and inflation. This is known as the Phillips Curve, really important economic concept. So as unemployment, as you can see, as unemployment gets lower and lower, typically it creates inflationary pressures in the economy, and inflation goes higher and higher. And the same is true when unemployment increases, typically the inflation comes down as a result of the fact that there are plenty of people looking for jobs and competitive pressures on folks that are looking for jobs, and there are fewer jobs. Now we have reverse. We have very few folks looking for jobs, relatively speaking, and the competitive pressures between corporations for talents forcing the pay increases. So it's actually a good thing in many ways, but we'll get to that in a minute. The Federal Reserve Bank, unfortunately or fortunately, has to act. Very high inflation is not good for the economy. There are all kinds of problems as it becomes sort of a tax on the economy, especially on the we'll call them working poor. So inflation is not necessarily a very welcome factor, we're dealing with high inflation. So the Fed has no choice but to use its only lever that they control and raise interest rates. And that's what's been announced. And let's go to the next slide. So here is the outlook for 2022. And this is a comment from CBRE.us. US commercial real estate is set for a very active 2022 amid robust growth. And again, I'm not going to read the quote, but the anticipation is that the substantial capital is entering real estate market for the reasons that it is a hedge against inflation, and real estate is a better hedge against inflation than the stock market. We are seeing the volatility in the stock market already as a result of Fed commentary on the 4 rate increases for next year. Again, interest rate increase works as a extinguisher of the stock market fire. In other words, as investors are gearing up for the stock market volatility, they have to shift the dollars somewhere. And real estate is projected to be that one sector that could benefit from stock market volatility, and more capital is looking for deals. So the deal flow is the supply of deals is what's available today, but the capital chasing those deals is projected to increase, increasing the volume of transactions and the prices paid. So interestingly enough, real estate does not necessarily benefit from higher cost of financing, but as a substitution effect out of a stock market and the already projected inflows of capital, 2022 is expected to be a pretty strong year for real estate investors. On the GDP growth side, US GDP is projected to grow at 4.6% annual rate in 2022, which is, again, historically strong. Pre-COVID, we saw GDP growth in the 2.5% range. So again, inflation, GDP growth, global supply chain issues continue to be in the news, and they're not likely to go away overnight. There are multiple theories why. One of them is that multiple other countries, not just the US, are looking to reopen their commerce with Omicron coming down, and the demand for goods and services are likely to be strong in all around the globe. So the supply chain is slow to start, and it takes a while to get the production up. So the current theory is that the global supply chain will take probably another 2 years to get back to normal, unless some other black swan event and some other substantial disruptions take place. Obviously, various COVID a future generation of the COVID virus, the weaker strands could still cause some level of disruptions and fresh closings, and that's still an unknown. Again, inflation is likely to stay at the elevated level through 2022 and beyond. Again, what's driving the inflation? Strong consumer demand. This point, consumer is benefiting from personal income growth from a lot of government programs injecting cash in the economy, and the consumer is strong in general. Although I'll make this comment, with substantial inflation, retail numbers for December were somewhat weaker, or a little disappointing, as consumers were prudent and were looking for bargains and decided not to spend as much as they would otherwise with the rapidly escalating prices for everything from big screen TVs to the food in the stores. So inflation, on one hand, is a healthy thing for the economy. On the other thing, it is a substantial concern for consumers' ability to continue to spend with a high inflation environment. Supply chain issues obviously driving inflation. The lack of goods, as I mentioned, instead of 10 apples, we're dealing with 8 apples available out there because of a supply chain. Fewer apples, higher price per apple. Again, COVID variant Omicron is still ravaging out there. It's a weaker strand, but at the same time, it is still a substantial concern, and the economy suffers as a result of Omicron. Rising prices of commodities, materials, transportation, labor, and housing, everything seems to be going up. It almost becomes like a spiral. What's really interesting is we're looking at real estate. We recently discussed some of the construction projects in the budgets, and it has become increasingly more difficult to estimate the cost of materials and labor on the development projects. So the risks associated with the development projects have gone up. A lot of the investment is speculating that the higher cost of construction and labor will be offset by higher future prices, but it is a speculative, obviously, theory. So again, all those things are driving inflation. Recovery is resilient despite ongoing COVID risks. So because of the strength of the economy, low unemployment, high inflation, the Fed has no choice but to increase interest rates. So the Fed controls short-term rates, the discount rate. However, they also control what is known as a Fed balance sheet. So what they can do is make decisions to shrink the Fed balance sheet by selling their treasuries that they hold on a Fed balance sheet in an open market. The result of those sales would cause the interest rate to go up. So we don't know exactly what they're going to do, but they expect the rates to go up, and they'll probably use both of their power in setting the Fed target rate and then discount rate that they lend to the banks, as well as the ability to bring additional supply of treasuries to the market, which would increase the interest rates on the 10-year treasury, which is one of the primary drivers of a lot of mortgage financing and a lot of other long-term interest rates. So the target rate for 2022, well, it's not a target rate, but a projected rate on 10-year treasury would go to between 2.25% to 2.5%. 10-year treasury was trading at about about a 1.75%, 175 basis points today, and it is projected to go up at least 50 to 75 basis points. It is possible. I heard different theories that the Fed would allow the 10-year treasury to go as high as 3%. A lot of it is unknown. There's another interesting effect as stock market volatility increases with the interest rate increases. There's also the substitution effect where the dollars that exiting stock market could go into the bond market and in fact buying treasuries as a safe harbor during the period of volatility, which would limit the increase in the interest rates. So what we're sure is that the rates are going up. We don't know how much they're going to go up. Fed is notoriously late to the game. When they wake up and they start acting, it's usually a year or a year and a half late. Some of this stuff should have been done earlier, but they were very cautious. And now when the economy is sort of on fire, they are going to start increasing rates, and they probably will miss the point where they need to stop. This has been a historic pattern. They usually look at the data and look at the data and look at the data. And when they see that all the data and then nobody else can tell them that there's anything happening in the reverse direction, that's when they take action. And by the time they're done taking action, everybody's going to tell them you've overdone it. That's kind of what I've seen happening historically. Again, the demand for real estate is likely to stay strong despite the rising interest rates for a few factors. Continuing growth in the rental rates. So the price of assets is a function of net operating income. A lot of the properties, especially commercial properties, trade on a cap rate. So as rental rates go up, so does the net operating income, and so does the price of the corresponding real estate. The higher cost of financing or higher interest rates do slow things down for sure, but the lack of alternative strong hedges against inflation is going to drive a lot of capital in the real estate market. What's really fascinating is that some folks are talking about, well, we are now going to invest in the crypto as a hedge. And again, I'm not bashing crypto, nor am I supporting crypto. It's something outside of my expertise, but for comparison's sake, crypto doesn't have any real value other than the strength of the network and a few other things. With real estate, you have actually a hard asset. And as the cost of reconstruction is going up, the value of the asset is basically driven by a cost inflation. So real estate is likely a great hedge against inflation, while crypto and other, including gold and silver, which, as Warren Buffett calls, they don't reproduce. They are hedged against inflations to some degree, but at the same time, gold and silver is real. Crypto is, it's as long as people believe in it and as long as the network is strong. So there are other hedges against inflation. However, real estate, in my view, is the best hedge. So large capital inflows into real estate funds and a competitive buyer bidding for quality assets. This is a really important point, as institutional capital is flowing in larger numbers into the high quality assets. And what we may see is interest rates are going up, but so would the prices of real estate because of the inflation, because of the high demand. The other critical point is there's an availability of great mortgage financing. The credit fairly loose today. Underwriting standards have softened up. More and more lenders entering the market, offering the product. And we're observing it's not 2008, 2009 again. Nonetheless, the lenders are pretty competitive, and there are a lot of good options out there for the borrowers to get financing for both owner-occupied investment properties as well as commercial projects. So here's an interesting graph. This comes from CBRE research. These are the capital inflows into real estate, commercial real estate. As you could see, the capital inflows dropped during COVID in 2020. However, they picked up substantially in 2021, exceeding previous high. This data was pulled in October, and they were projecting the year to finish strong, and the year did finish strong. Now, 2022 is obviously a projection, but the projection is to see growth and the levels of commercial activity exceed all-time highs. So the capital inflows will drive both higher prices, more competitive pressures, and likely going to produce a very strong year for real estate investment in commercial and residential. So here is another very important graph. Well, so it's not a graph, it's essentially the three graphs in this graph. So this shows essentially a mix of the gray area are 10-year treasuries. So what's gray is reflecting a 10-year treasury rate. Then above the treasury rate, the blue is what is known as a debt spread. Debt spread is the delta between the mortgage rates offered by banks on commercial projects versus the 10-year treasury. So that's the spread, that's the blue. And then the dark blue is what is known as an equity spread. And that's the difference between the cap rates investors paying and then the mortgage rates available for commercial properties. So one of the really very important correlations is there's a long-term correlation between mortgage rates and cap rates. So as mortgage rates fall, so do cap rates. And we've seen a cap rate compression environment across all sectors of real estate since pretty much the crisis of 2008 and 9. As you can see, the cap rates have been slowly but surely coming down. So they're pretty well compressed. And in general, as 10-year treasury is expected to go up, so would the mortgage rates offered on commercial projects. And following the same theory, the cap rates may expand. And that process, the cap rate expansion, is not necessarily great for real estate. It just means investors would demand higher return on the investment, so they would pay lower prices. Again, the cap rates and the prices have inverse relationship. The higher the cap rates, the lower the prices in theory. But what's really interesting is that the equity spread, this dark blue, may actually shrink or tighten. What does that mean? It means that as interest rates may climb in 2022, the equity investors may still choose to buy the assets regardless of the fact that the cost of financing has gone up. Agreeing to a lower equity spread, that spread between the cap rate that they're paying for the asset versus the mortgage cost of capital. So we might see a dual phenomenon where cap rates see a little bit of the expansion. At the same time, the equity spread may shrink, and the prices will continue to stay very, very strong as a result of the capital inflows in the commercial real estate. That's what the data tells us. High inflation is driving substantial shortage of affordable housing. And higher cost of construction due to supply chain issues combined with the wage growth are driving overall cost to bring new housing units to the market. So any new development of multifamily or single family real estate built to rent heavily depends on the cost of materials and the cost of labor to put those projects together. So with this highly inflationary environment, the supply of the entry-level housing or affordable housing is under substantial pressure. If people build, they build typically higher end, more expensive units. Building entry-level housing is just not as profitable as building something at a higher price point. So the supply is short, and the demand is pretty high. We have new family formation, there's substantial immigration, and there's a COVID effect where many folks want to have privacy. So demand for residential housing has grown during COVID, while the supply growth has been very, very limited and continues to be limited by this continuous inflation. So ground up projects are both costly and they are subject to substantial delays related to the supply chain issues. What's really fascinating, I've talked to a number of developers, and they basically at this point try to buy all the materials well in advance, whatever they can buy. It's not a matter of I want this appliance or I want this fixture. It's more like what's available. We will buy whatever's available today and store it in a warehouse. If we can't store it, we can't buy it. It presents massive risk to the project that the project cannot finish. Especially if you're missing windows, which is a massive risk factor today. Getting windows ordered and delivered is a substantial risk to finish the project. So we're dealing with ongoing supply chain issues, and it's not looking like it's going to go away anytime soon. So again, ground up project costs more, harder to predict the costs and harder to project the completion date. What's really interesting is something that we've been investing in the past, and we love this sector. And this is, in my view, still very, very attractive sector and presents substantially better investment opportunity creating affordable housing. And that is conversion of hotels to multifamily housing or workforce housing. Why is it so attractive? Well, because it is a lot less expensive to convert than to build ground up. You have an existing structure. The apartments may be small, but the units of extended stay hotel or even studios of hotels, they are built units. Yes, there's some cosmetic renovations that need to take place. Yes, there may be a kitchenette that needs to be installed, but overall, the cost and the time to deliver redeveloped hotels to multifamily is a lot faster and better than ground up projects. So using this general thesis, we love hotel to multifamily conversions as well as value add multifamily projects. So value add multifamily projects, again, there are three primary ways to get into multifamily: build ground up, redevelop hotel to multifamily, or take an existing asset, take it through improvements, both roofs, siding, and internal renovation of units, as well as rent increases. Those three are the main methodologies how these multifamily properties are created. And we love, again, conversions, and we also love value add because value add work is substantially more predictable and less, so both it's predictable in cost and predictable in time. When you have renovation of an apartment, it's carpet paint, maybe kitchen cabinets, some appliances. It's a lower risk versus building ground up. So those two strategies deliver what is in high demand, and it's very easy to push through rent increases on the newly renovated units. In fact, most of the projects we've invested in recently, we've seen that the rents, post-renovation rents, substantially exceed the original projections of what these rents were based on a pro forma at the initial time of the investment. So if past is any indication of the future, these two projects, these two types of projects, what we've seen over the last couple of years have been great investment asset classes, and we continue to think that they will be for the upcoming 2022 and beyond.
Thank you, Mike, for those details on the state of the market. We will, of course, continue with the additional details that we have to follow. Let me just introduce to folks our new fund that we're launching in early February 22. And folks, the numbers you see on the screen are preliminary. We're still in discussions, and it's still work in progress. But the main idea behind Tampa Growth Fund 2 is, while it's going to continue investing in the type of assets we've been investing in Tampa Growth Fund 1, and mainly, as Mike mentioned in the past, we try to stay away from the new constructions for the supply chain issues. And that's, again, because we're trying to stay in close touch with what's going on with the economy. And, you know, if we see any changes, we will be changing our strategy and adjusting it as we go. But hotels to affordable housing conversion are definitely on the top of our list. We are going to be looking for a lot more multifamily and affordable housing units to bring into the fund, self-storage, industrial, and other commercial real estate as well. But the main idea behind Tampa Growth Fund 2 is offer something that a lot of investors have been reaching out and asking us for, which is to offer investors a way to obtain a higher depreciation. And as you see, Class B subset of units will offer investors up to 100% of depreciation, while Class A units will have no to little depreciation, but they will offer a much higher preferred return. And this would be an ideal class for IRA investors. Both classes are IRA friendly, but obviously folks that are in need of depreciation would be investing with cash to take full advantage of that depreciation. And you see a slight difference in the annualized return, but again, the main emphasis here is the difference of obtaining higher depreciation, and through that depreciation, higher losses, of course, in Class B of units. And for folks that want to have a much higher preferred return than Class A of units, is ideal for them. Again, this is still work in progress. Please give us another week or two. We will do a full official announcement. We'll record the webinar and provide you all of the details about Tampa Growth Fund. But I just wanted to give you kind of an early introduction into what's coming in early February. If you guys are interested and want to put your name on a wait list or want to be one of the first one, by all means, feel free to reach out to me, schedule time, or just send me a quick email with your interest, and I'll make a note of it to make sure that you're on top of our list for this fund.
Brilliant, again, for the introduction of Tampa Growth Fund 2 as an upcoming fund. So storage, let's just talk a little bit about storage. Storage was also a very exciting sector in 2021. And it's looking pretty strong in 2022. We have substantial investments in a number of storage projects in both Tampa Opportunity Fund and Tampa Growth Fund, and we're very excited about what we've acquired and upcoming deals as well. Again, the pandemic fueled the industry. Lots of folks had decided to stay home, work from home, and corporations encouraged that, and privacy basically drove a lot of folks to relocate. They went from big cities to suburbs. Every time there's relocation, it is great news for storage, because all the treasures or junk, whatever you want to call it, someone else's treasure and another person's junk, has to be stored somewhere in between. And you see this, by the way, you see this in big cities too. I'm in Brooklyn, New York. I can tell you we've seen a lot of new storage development because there was very limited supply, and most people live in buildings. They need to store stuff somewhere. So it definitely works in big cities, and it works also obviously in outside of major metropolitan areas, as folks not ready to unpack their stuff, they need to be storing it temporarily. The demand for units has grown quite a bit. Revenues have grown on average between 15 to 20%, in some cases substantially higher. So very substantial growth in the revenues in the storage. The net operating incomes have grown even faster. A lot of deals operate on leverage. So leverage storage deals have generated NOI growths 30 to 40%, in some cases even higher. What's really amazing is that the storage REIT index have gone up even higher. Once again, I just want to caution that the publicly traded REITs, they trade like stocks. As investor sentiment is strong, the price of REIT, price per unit or per share, could be substantially higher of the net operating income that the portfolio derives. But when you project future revenue growth, investors pay even a higher price today for a future growth. So the REIT had done phenomenally well, or the REIT index in 2021. And major strengths, ability to increase rents on short-term notice. Why? Because most of the storage rents are monthly. So having spoken with a number of our operators, folks we've invested with, they are planning to continue to increase rental rates on storage units, typically as often as twice a year, and sometimes even faster. So rent increases will continue to be the story of the day in 2022, and the industry in general should do very well. So we're very delighted to have substantial investments in the sector. We'll continue to make investments as we find great projects. Retail sector. So this is kind of interesting. As I mentioned previously, retail sales dropped 1.9% in December, simply because of the inflation. The prices have gone up so much that consumer spending has responded to a degree of that inflationary pressure. So even during the holidays, when folks spend, there was a consideration for the fact that these big screen TVs and everything else, the prices have continued to escalate. And at some point, the consumers decide to delay their purchase or buy a smaller unit or whatever they need to buy. So this was really interesting development that has created a little bit of a concern that the accelerating inflation may slow down consumer spending. As far as where the opportunities in the retail real estate sector, there's a great consensus out there. So the best opportunities are in the open air shopping centers, basically shopping plazas, some experiential real estate where it's an open air type of environment, as well as a single tenant drive-through. Typically, these things could sit on a single out parcel, or they could be part of a shopping plaza. But the drive-through demand is very high. Folks don't want to go into the store itself. They prefer to order, pick up their food or their coffee, and move on, maintaining privacy. So that's the best opportunities in 2022. We continue to talk to a number of sponsors and operators in the space who we have good relationship with, and they are looking for good deals. Again, some interesting opportunities may come up, and typically the way of the old mall is a dinosaur path. Here is the point: is the department stores will continue to shrink. Some of the old malls will continue to close or do worse. Macy's announced they were planning to close 125 stores in the lower tier malls in 2022. So again, consumer behavior is shifting to open-end type of shopping environment, and then the old enclosed malls continue to struggle. Again, this does not include some of the new developments, some new projects with real experiential type of environment, but something to keep in mind when making investment decisions for 2022. Business travel and convention real estate in 2022. So as the country reopens after the current wave of Omicron and then potentially future waves, the virus loses its potency, its deadliness. The transmission rates could still be high, but the impact of the virus, it'll turn into effectively a common cold. So the result of that is people will continue to travel without as much fear as they had before, without worrying about bringing the virus back home and infecting the grandma. So again, hotel, restaurants, entertainment centers likely going to see further recovery throughout most of the 2022. And again, we don't know unless another black swan event or another variant of COVID with a lot more deadly potency shows up. I would expect the recovery not to be slowing down because of new variant of COVID. If our experts are correct, the future variants of it should be weaker, not stronger. That's how historically these type of viruses mutate. So investment considerations for 2022. Again, this is a little bit of a recap. Construction cost, labor, and materials are still climbing. And I can't stress this enough. We were looking at potential projects ground up, and it is a struggle to comfortably invest in those projects because it's difficult to predict how long things will take, whether there's going to be disruption in materials and actual cost or the budget for these projects. Redevelopments and conversions are a lot more attractive, as I mentioned before, but the ground up projects still happening. There are plenty of speculative investors who are very comfortable. We feel that it's not necessarily something that is fundamentally wrong. It's just different. So for us, we are more comfortable with a lower level of risk on these type of projects, and that's why we gravitate to, as I mentioned, conversions and value add projects in the multifamily space. Storage, as mentioned previously, is a great asset class that should do very well with the inflation, and we plan to continue to invest in the sector. And the other really important point in consideration for 2022 is high interest rates create substantial stock market volatility. And look at what has happened over the last few days in the market. So volatility doesn't mean the prices continue to drop, but we're definitely already in the correction territory. We see up and down days, but the trend in general is that high interest rates create substantial pressures on corporate earnings, as a lot of companies have heavily leveraged balance sheets. So companies with limited earnings as is will struggle in the higher interest rate environment. And here are some quotes from finance side. Again, stock plummeted, Dow dropped. This was in response to 10-year Treasury rate increases. And I would expect this to continue. Now, I do want to put, I hate to put the fear, I'm not a fear monger, if there's such a term. At the same time, the stocks have done extremely well for a very long time. Maybe at this point of time, a substantial correction is in the cards, in a manner of speaking. So something to keep in mind as interest rates increase, a lot of stocks attractiveness, especially those with limited earnings, it will continue to put downward pressure on those stocks. And in this environment, it's even more important to pay attention who you're investing with and what kind of deals. As you've heard me speak in the past, All investment decisions, at least in our view, follow this process. Always first, who you're investing with. You got to know, like, and trust your fund manager, your syndication operator, your sponsor. Always starts with a person and their team and the organization. It's not, again, not Big Mike. It's TF Management Group, and it's not one sponsor. It's whatever the company is. But it always starts with that organization to a deal selection, and that is something that is even more important this year, selecting the right type of deals. And then the third element is obviously negotiating best terms. This is what we do. This is the reason folks invest with us, is because we use our relationships and our strength in numbers, bigger dollars, to negotiate better terms for our family of funds. And the other key point that I wanted to mention is diversification is critical, especially in the environment of high interest rates. A broadly diversified portfolio should do better versus a single focus syndication or one-off commercial deal. So investing in a diversified fund will reduce the risks of a correction in one subsector or just any single project risk.
Thank you, Mike. That was a very detailed state of market overview, and allow me to give a recap of our Tampa Income Fund that we launched at the end of last summer. And even though it operated for one full cycle, Q3, we were happy to report very strong results. As you see, we made over 13% on an annualized basis in that fund. The fund is geared towards the folks that are interested in obtaining immediate passive income. It pays quarterly dividends, quarterly distributions, and it offers two subsets of different units. It offers A through C classes of units that pay 7% pref with additional split for classes A through C, as well as the discount lots units that pay anywhere from 12 to 15%. But as you can see from this Q3 table that we're sharing, the folks in classes A through C were able to obtain the 13% annualized return because of the strong beginning of the fund. The fund is diversified. It invests in various asset classes geographically, different investment strategies. We will continue bringing different projects into the fund, as it's open-ended evergreen fund, so it'll continue to exist for many, many years ahead. And while it is geared for folks looking for immediate passive income, one of the advantages it also has is, if you're not looking for the immediate distributions, you can choose to reinvest your distributions and take advantage of the compounding, which also allows you to change that option at any time every quarter. So if you know that you don't need distributions for the next year or a couple of years or so and so forth, but would like to change it at any time, you would be able to change it at any point in the future. So consider that for any of your purposes. And it is IRA friendly, so whether you plan to investing with cash or with your qualified funds, both sources are welcomed. And so feel free to schedule some time with me, and I'm happy to answer your questions about the Tampa Income Fund. With that, it completes our presentation for today. Again, Mike, thank you for the fantastic overview of state of the market. And folks, at this point, we're welcoming questions. Feel free to post them in a Q&A or in a chat. And in the meantime, if you would like to have, while we're waiting for the questions, if you'd like to have a conversation about anything you heard today or about any of our funds or future offerings, feel free to schedule time with either Mike or myself. Our contact information is on the screen. And we're very, very grateful for your attention today and for being part of our Tampa community. We're super delighted to have you as a part of our group.
Thank you, Alina, very much for a great summary, and the floor is open to questions. If there are no questions, we'll keep it short. It's sometimes what's really interesting is some of your questions come later through private emails, texts, and calls. So if you have great questions now, great. If not, no worries at all. We'll happily answer individual questions and yeah, and respond individually.
First question, I believe it's about Tampa Growth Fund 2. What is the minimum investment going to be for the new fund?
So Tampa Growth Fund, a great question. Thank you for asking it. It's going to be 100,000 minimum. So we basically migrated from Tampa Growth Fund original one, the one that just closed, being 250, to the Tampa Growth Fund 2, understanding some of the thoughts and requests to have a minimum, smaller minimum. So we designed it. We're still in the final stages of this design work, but the Class C units, not Class C, there will be Class A and Class B, but there will be 3 tiers based on dollar amount invested. There will be $100,000 tier. It's a minimum investment. Then there will be a $500,000 tier, and then $1 million tier. And the $1 million tier will be on an 80-20 split. The $500,000 tier will be on a 70-30 split, and $100,000 tier will be on a 60-40 split above the preferred return in the fund. And preferred return will vary for the Class A units. It will be 12%, and for Class B units will be 8%. There will be an adjustment for a relationship between classes, or between these preferred class of units, Class A. I can go back to the slide on the, well, we don't have it here for Tampa Growth Fund, but two. But there will be a relationship between preferred equity, which is Class A, and a common equity, which is Class B. So the preferred equity will be senior on a capital stack. It'll have 12% pref, and it'll capture 30% of the overall upside in the fund, while the Class B units, at least this is in the current design, we are still finalizing. The Class B units, which is common equity units, will have 8% pref, but they'll capture 70% of the upside. And the splits that I mentioned, 80-20, 70-30, 60-40, will exist within each subclass of Class A and Class B. I hope it's not confusing folks. To make long story short, we're still in the final stages of designing it, but it'll work similarly from economic perspective as Tampa Growth Fund. The primary difference is, again, we are separating depreciation into Class B units, majority of it, and the Class A units will act like a preferred equity with seniority of the capital, seniority of the pref, and a higher pref, which will create higher safety for Class A units, but the Class A units will not have the cash flow. That's why Alina's point about IRAs going into Class A makes total sense. So it will be highly unlikely that an IRA investor or a 401k would go into Class B units because the depreciation doesn't benefit them. So Class A becomes, let's just call them an ideal target for qualified money, and a Class B units, common equity units with extra depreciation, become great target for folks to invest cash that need outside depreciation to help offset other passive income from real estate, rental income, as well as capital gains coming from the sale of appreciated property.
Thank you, Mike. Super detailed questions. And folks, again, the fund will launch in early February. Until then, feel free to reach out if you want to add your name to the wait list or schedule some time for when it launches so we can discuss it further. And we will, of course, grant the relationship balance to all of our investors. So whatever other investments you have with us in the Tampa family of funds, that will be applied towards your balance for the Tampa Growth Fund too. I don't see any more questions. I hope it's a good sign. Hopefully, Mike's state of the market presentation had answered most of your questions about the state of the current economy. If you do come up with a question later, feel free to reach out to us later on. Thank you very much again, everyone. Great to have you with us today. Have a
Thank
good
you,
night.
kind. Thank you, Alina.
Thank you. Have a good night. Bye.
Good night.